Thank you to all of our attendees that are here as well. This is the Basics in Professional Business Valuation webinar. We're joined today by Anastasia Bourgeois with INNP. She's going to be talking to us about business valuation, the basics, what it means, how to do it, all that good stuff, and what she does at INNP as well. So with that, if everybody could just go ahead and mute your microphone. We do also want this to be as informative and interactive as possible. So if you do have any questions, feel free to chat them to me or put them in the Q&A box, and we'll be happy to get those answered for you. And with that, Anastasia, I'll let you go ahead and introduce yourself while I pull up your slides.
Great, thank you. Good afternoon, everybody. My name is Anastasia Bourgeois. I'm the owner of INNP Valuations and Consulting, an independent consulting firm based in Austin, specializing in business valuations of closely held companies. I hold a Certified Valuation Analyst certification from the National Association of Certified Valuators and Analysts. And once the slides are up, and they are, I'll be delighted to present to you the basics of business valuation. Ashley, can we move on to the slide?
Yes, ma'am.
Thank you.
Getting this going. There we go. All right.
This is my contact information. You'll also be able to see it at the end of the presentation. Okay, next slide, please. Okay, before we talk about a professional business valuation, which is the topic of my speech today, let's talk about any business valuation and who can perform a business valuation. In general, a business valuation is a process of determining how much the business or a percentage of ownership in a business is worth. As you can see on the slide, there are 4 groups of individuals or professionals who can perform business valuations: business owners, business brokers, certified public accountants, and accredited business appraisers. I myself belong to a group of accredited business appraisers. Let's talk about business owners. Business owners always want to know how much the companies are worth. And sometimes they try to estimate the value by picking a price multiple, such as price to revenue or price to EBITDA. Maybe they've heard about a multiple from another business owner, or they've seen it on the broker's website, and they try to apply the multiple to their company's financial metrics. You have to be careful by simply using such multiple-based formula because 2 seemingly similar companies with the same revenue or EBITDA may have significantly different values due to different growth rates or risk profiles. Another way of estimating the value of a business may be by looking at your balance sheet and adding up all of your assets and subtracting outstanding liabilities. One of the biggest challenges using this method is adjusting your book values of assets and liabilities to their fair market values. Business brokers perform business valuations for clients who are getting ready to sell their business. Some brokers do not charge a fee for calculating the value of a business. Some charge a discounted rate compared to those charged by accredited business appraisers. Ultimately, business brokers are hoping to earn a commission on the sale of your business. Generally, to perform a credible, well-founded valuation, an appraiser like myself will spend about 20 to 30 hours and will need access to a lot of data that costs money. Your business broker may or may not have enough time available to devote to your business valuation or have access to the data. And generally speaking, business brokers are considered not independent or not objective because their goal is ultimately to sell the business to earn a commission. Talking about CPAs, less than 5% of CPAs have expertise and credentials to perform valuations. Most of them won't appraise their own clients' businesses, even if qualified to do so, because they have an inherent conflict of interest, especially when performing audit work. And an accredited business appraiser is a professional who specializes in business valuations and holds a professional designation. that is awarded by any of the 4 organizations in the United States, such as the National Association of Certified Valuators and Analysts or the American Institute of Certified Public Accountants. These designations are based on certain educational and professional credentials, such as earning a college degree and having a minimum of 2 to 15 years of experience performing business valuations. So accredited business appraisers offer independent and unbiased opinion. Their valuations are performed in accordance with professional valuation standards that encompass mandatory rules and guidance for best industry practices. And those valuations are most likely to represent the actual value of the business. Next slide, please. So let's talk about how to determine the value of a business. No single set formula exists for determining a company's value. When performing a professional business valuation, an appraiser applies valuation approaches and methods deemed to be appropriate under the facts and circumstances of each valuation based on the appraiser's informed professional judgment. Although no set formula exists, IRS ruling 5960 defines key factors that must be considered when valuing the stock of a closely held company. And those factors are the nature and history of the business, the financial condition of the business, the economic outlook in general, and the condition and outlook of the specific industry, the earning capacity, the dividend paying capacity of your business, whether or not the business has goodwill or other intangible value, the size of the block of stock to be valued, and the market price of stocks of companies engaged in similar line of business. Next slide, please. Okay. Here I listed key attributes that every professional valuation possesses. Attribute 1, all business valuations are performed for a clearly defined purpose that is documented in an engagement letter prior to the beginning of an engagement. Business valuations cannot be used for any other purpose. For example, a valuation performed to help a client consider a sale of a business cannot be used in a divorce or dissenting shareholder litigation. Attribute 2, evaluation can only be used by the intended party. For example, evaluation performed for a business owner to help consider a sale of a business cannot be used by his or her heirs for estate tax purposes. Attribute 3, valuations are only valid for a specific valuation date. Now, the date on which the business is being valued is critically important because circumstances can cause values to vary materially from one day to the other, just like prices of publicly traded companies on the stock market. Attribute 4, valuations can be classified as required or good to have. Required valuations are required by IRS or a court. They're triggered by a specific event, such as a gift contribution or the death of a shareholder, and they need to follow set timeframes. Examples of such valuations include valuations for estate and gift tax purposes. On the other hand, good to have valuations are not required, not triggered by a specific event, and they're used by business owners to make decisions about their future. Good to have valuations include those performed to help consider a purchase or sale of a business, for entry exit of a partner, capital infusions, setting up or updating a buy-sell agreement. And attribute 5, evaluation is not an audit. Evaluation process does not include auditing financial records of the business. Financial statements provided by the company's management are accepted without additional verification as correctly reflecting the value and the nature of the business. Let's go to the next slide, please.
Real quick, Anastasia, we had a couple questions come through already. So the first one is, how do you evaluate valuation in these uncertain pandemic times, specifically for startups?
Sure. So there are two Main things to consider. One, we are evaluating a startup, and two, we're evaluating any company during these uncertain times. So when we talk about a startup, generally there are extra risks and uncertainties, such as risk that the company will fail, private sources of financing, and lack of historical or future projections or operating activities. So here, appraisers will either project future expected earnings and revenue, or use projections from the management, or a lot of times they fall back on storytelling. They look at the industry overall, the potential for profit, the potential for market share acquisition. So storytelling becomes very important. And when we talk about specific impact of COVID-19, an appraiser will look at the industry in which this new startup operates, and we'll look at the impact. A lot of businesses have been impacted negatively in February, March, and they're back on track currently. A lot of them will be impacted heavily for years to come, and a lot of businesses actually benefiting from COVID-19 pandemic. So the specific industry and the type of business and how similar companies got affected will play out heavily in the valuation of a startup. I hope that clarifies the question.
Okay, we'll go ahead and move on with the slides and then get to the rest of the questions towards the end. Thanks, Anastasia.
Great, thanks, Ashley. Okay, next slide, please. So all business valuations are performed for a clearly defined purpose. The purpose of the valuation affects the assumptions and methodologies used to determine value. The main purposes of any valuation include estate and gift tax, such as valuations to help calculate estate and gift tax, mergers and acquisitions related valuations, for example, those for pre-acquisition analysis and fairness and solvency opinions. You have financial reporting related valuations, such as valuations for purchase price allocation and C Corp to S Corp conversion, management planning valuations, such as those related to buy-sell agreements and sale of a business. And you have valuations in litigation related to shareholder disputes or divorce. Okay, next slide, please. Here I'm going to talk about standards of value. Long ago, Warren Buffett quoted that price is what you pay and value is what you get. Almost everyone has an opinion of value, and whether it's for a business or an asset, and unfortunately the term value means different things to different people. A standard of value when it comes to professional business valuations is the type of value being used in a specific valuation engagement based on the purpose of evaluation and other factors. Standards of value may include fair market value, fair value, and strategic investment value. In the United States, most widely recognized and accepted standard of value is fair market value. It is a standard used in all federal tax matters, including for gift, estate, and income taxes. IRS has defined fair market value as the price at which the property will change hands between a willing buyer and a willing seller when the former is not under any compulsion to buy and the latter is not under any compulsion to sell, and both parties have reasonable knowledge of relevant facts. Okay, I'd like to move on to the next slide, please. This slide has a lot of information. It gives you a summary of every step in the business valuation process. I'm going to go over each step quickly and give you a little bit of color. Overall, there are 7 main steps in the business valuation process. Step number 1, defining scope. Here, a business appraiser identifies the ownership interest to be valued, the valuation date, the purpose of the valuation, the standard of value to be used, the type of engagement, and the type of a report that are needed. And if all necessary information is available. Step 2, document production. An appraiser like myself will provide an initial request for documents and information. necessary to prepare an objective or well-founded business valuation. Documents that need to be produced by the owner or management of the company may include historical and projected financial statements, such as balance sheets and income statements, as well as tax returns, articles of incorporation or operating agreement, any buy-sell agreements, franchise agreements, leases, etc. Step 3, review and analysis. An appraiser will review the economic outlook, relevant industry data, and gain a thorough understanding of the nature, history, and financial conditions of the company being valued. An appraiser will also perform an interview with the owner and the management, and in most cases, a site visit. Step number 4, normalization of earnings. Before applying any valuation approach, the company's historical financial statements are adjusted or normalized to represent a more economically realistic operating results or fair market values when it comes to companies' assets and liabilities. Adjustments here include removal of non-operating and non-recurrent assets or liabilities or income and expenses, removal of excess officers' compensation, and adjusting methods of costing inventory. Step number 5, valuation analysis itself. In every valuation engagement, an appraiser is required to consider 3 main valuation approaches, and I'm gonna talk about those in the next slide. The asset, market, and income approach. An appraiser usually relies on 1 or 2 of the approaches to arrive at the conclusion of value, depending on the purpose and specifics of the valuation. Step number 6, applications of discounts and premiums. When deemed appropriate, a business appraiser applies certain adjustments to the company's value. Such adjustments might include a control premium, a discount for lack of control, or a discount for lack of marketability. And finally, step 7, conclusion of value. Based on appraiser's informed judgment, reasonableness, and common sense, an appraiser reconciles the values indicated by the various valuation approaches to reach a final estimate of value after considering all relevant facts and fundamental considerations of the valuation. And lastly, a final report is produced and sent to the client. Okay, let's move on to the next slide, please. 3 main valuation approaches. Okay, so this is very important, so pay attention, everybody. The main approaches in professional business valuations are asset, market, and income approach. And all 3 are required to be considered. The asset approach allows to establish a floor value of the company, which is the minimum value that would be realized upon a sale of the company's assets and satisfaction of its liabilities. The asset approach is defined as a way of determining the value of a business by adding all tangible and intangible, recorded and unrecorded assets, and subtracting all outstanding liabilities. An asset approach is an appropriate approach for estimating the value of non-operating businesses, such as a closely held partnership with large investments in stock, bonds, or real estate. The market approach bases the value of a company on how similar companies, both private and public, were priced in the market in the past. Appropriate pricing multiples are calculated and applied to revenue and earnings. Typically, this valuation approach is particularly useful when valuing public companies or large to medium-sized privately held companies, because data on comparable public businesses is readily available. This approach is rather difficult to use for relatively small privately held companies because there may be not enough comparable companies in the same sector or with similar valuation fundamentals. And the income approach bases the value of a business on its ability to generate future earnings. This approach estimates the value of a company by projecting future expected earnings and discounting them into a single present value. This approach may be applied to value both well-established and young companies. Let's see. Next slide, please. This slide talks about types of valuation engagements and the fees that are charged. The ranges of prices you see on the slide is what our company typically charges our clients. These fees exclude fees for using the work of a specialist, such as a professional real estate or equipment appraiser, staffing company, or IP attorney. Such fees for using the work of a specialist are typically negotiated and paid directly by the client to that specialist. So in accordance with the professional standards, there are 3 types of valuation engagements: a calculation, a summary valuation, and a detailed valuation engagement. A calculation engagement takes place when the client and an appraiser agree on specific valuation approaches and methods to be applied in a valuation. It is less costly, with limited scope of work, and requires less in-depth research. Calculation engagements result in a calculation report, which may be represented by a set of calculation schedules. A calculated value may or may not represent the actual value of a business that would have been determined if all 3 valuation approaches are applied. Calculation engagements are most appropriate for internal company planning, for preliminary merger and acquisition situations, preliminary use for mediation and litigations, and for any buy-sell agreements that specify the use of a particular formula. Both summary and detailed valuation engagements are more costly, and they involve the full valuation process and more in-depth research. A valuation engagement requires that an appraiser considers, again, all 3 valuation approaches and apply methods deemed the most appropriate in appraiser's judgment to calculate the value of the company. Valuation engagement results in a detailed or summary valuation report. A summary valuation report represents an abridged version of a detailed valuation report with lower level of details. And detailed valuation report is a comprehensive formal written report with a high level of detail, and a lot of times it may exceed 100 pages. Most of what our company does is summary valuation reports. Let's see, I think with that, we're gonna move on to the last slide here. So this slide contains a special offer thanks to our close collaboration with 10 Capital Network. This offer is for 1 summary valuation and a formal written report for a total price of $3,000, representing a $5,000 value. And this offer includes a written summary valuation report, industry benchmark analysis, and consideration of all 3 valuation approaches. If you're interested in this offer, please reach out to me via email or by phone and provide basic information about the purpose of the desired valuation and the history of and financial condition of your business. You can see my contact information down on the bottom of the page. Let's see, I think with that, I think Ashley is going to open it up for Q&A.
Yes, thank you so much, Anastasia. That was very informative. We do have some questions lined up. Someone asked, we are developing an online portal for real-time valuation of businesses. Starting with the UK, we now have valuation estimates for approximately 1 million UK privately owned companies. Will you consider a collaboration to roll out this service in the US with an addressable market for 23 million private companies?
That sounds really exciting. I'd like to learn more about it, and possibly, yes, let's get in touch and take it offline. Thank you so much.
Great. Okay, next question. Is it typical for a business to get a professional valuation for a Series A raise, or is that something the investors will estimate and negotiate with the business owner?
Sure. It varies case by case. A lot of times a professional valuation will serve as a starting point for negotiations, and it's up to the owner itself whether you want to invest in a professional valuation or not. A lot of times what you'll see is that business owners will overestimate the value of the business, and it's great if you have a strategic buyer who is willing to pay a premium, but in a lot of cases it's it's really good to level set yourself as far as the value of the company when you have the professional valuation, when you could see conservatively what the business is worth. So it depends.
Okay. Next question. When a startup is pre-revenue, how do values of patent portfolio and goodwill enter into the valuation?
In order to evaluate an intangible asset like a patent, a lot of times a IP attorney will perform a valuation for a goodwill, for enterprise goodwill. And normally how it's calculated is by calculating the asset value of the company using an asset approach. And then when you look at projections for earnings and you calculate your income based value, if there's a difference between what's expected to be earned based on income and the difference between that number and your floor value assets and liabilities, that difference will be considered enterprise goodwill.
Okay. Thank you. It looks like as of right now, we have one more question. And we are about 4 minutes out from our 1:30 stop. So if anybody has any other questions, please feel free to pop them in now. I did also launch a poll. So if you could please just quickly answer that poll while Anastasia is answering these questions. And Anastasia, this next question is, can you give your thoughts on using replication value as a method for valuing a business?
Okay, yes, I think in this case, we're talking about a replacement value. When performing evaluation, in most cases, depending on the purpose of the valuation, an appraiser will use a going concern value, which is a value based on fair market prices. A lot of times, a liquidation will be used or a replacement value. Replacement value is typically used for companies that are not, for estimating things that are intangible, that are hard to calculate, for instance, as software. Developing software, the best way of calculating that is to ask yourself a question, how much would it cost me to hire a developer to recreate it? So in that particular case, I would use a replacement value. In most cases, I would use a fair market value for land, for real estate, for anything else that's tangible. So I would say a replacement value is used for intangible assets that are when there are no other fair market value estimation method is available. I hope it makes sense.
Great. And it looks like that is it for the questions for the moment. I'll give everyone just another minute or so to pop any in if we have any more. Again, please go ahead and answer the poll if you have a second. And Anastasia, we really appreciate your time here today. This was really informative. Looking forward to seeing how many other questions we have. And again, Anastasia's contact information is there on the bottom of the screen. Feel free to reach out to her. Also, if you have any questions about 10 Capital and our funding as a service program, feel free to reach out to me, info@10capital.group. We would be happy to answer any questions. And it looks like, ooh, one more question, just in the nick of time. Okay. When an investor disagrees, do you come back with answers?
When an investor disagrees, I'll be happy to go over the methodologies and methods and approaches used and show why those represent the standard of the industry, what's applied, what's conventionally used, and explain why those were applied. So I'll be happy to go over and paragraph by paragraph explain, yes.
Okay.
Mm-hmm. Well, yes, it's been my pleasure to present to you today. Thank you so much, and thank you for questions. If you have any questions, please call or email me. If it's not related to this offer, just you want to know more about the evaluation process. And thank you for being such a great audience.
Thank you so much. Thank you so much, Anastasia.